Welcome to Technical Tuesday on the Brilliant Fools podcast. And we're going to go over some everyone's favorite subject. This is what people live for when they get into business. Everybody thinks the part of business that I want to do the most is definitely the bookkeeping, the accounting. That's what I love. Okay, I know very few people who think that. If you are one of them, good for you. That's amazing. That's wonderful. I have done accounting for many years. I do not enjoy it. I do not enjoy it. I enjoy what I can understand from it, but I do not enjoy the thing itself. And that's really where we're coming from here today, is what can I understand from accounting and from the financial statements that are generated. What does accounting mean? How is it performed? What is a financial statement? What should I be looking for from a financial statement? What's the difference between a profit and loss and a cash flow statement, a balance sheet, my sales reports and aging reports and things like that? What's the difference and why does it even matter? It's kind of what we're going to get into here today. And I want to get a little bit more hands-on with it. If you're watching on a video, this will be a little easier for you to understand. I will do my best to explain it all. Oh, there we go. I will do my best to explain it all fairly clearly as possible. No guarantees, no big guarantees, but I'll try to explain it even if you're not seeing it on video. But I will say that if you are able to see the video of it, YouTube, Spotify, wherever, that's going to help you out a lot more than just listening to the audio. So let's get into it and let's see what we can find out. What is this thing called accounting? One of the first things I want to start with is just the concept of it. It is not counting. And I think that's one of the big things to understand. And for a business owner who's not really bent towards organization necessarily, I don't even know that I want to say it that way, but the detail-oriented aspect of organization, you got to double check and make sure all your apples are in your apple basket and your oranges are in your orange basket, all of that. Accounting can be kind of difficult for those of us who like to see things from the 30,000 foot view. But if you're like me, like I can get lost in the weeds when I start getting into it and start really trying to define the minutia of it. But the excellence is not found in the minutia. It's in the details, but not in like the detail of the details necessarily. Not for me anyway. As a business owner, that's not something I want to spend a lot of time in, and it's probably not good for me to spend a lot of time in that. But we'll get into some of that later as far as delegation and things are concerned. I've heard it said that the three people you want on your side when you're in business is you want a good banker, you want a good lawyer, and you want a good accountant. A good banker because cash flow is going to come up. Cash flow issues, they almost always occur, not necessarily, especially in a service-based industry. It may not be too bad, but even in service-based businesses, I've seen cash flow issues occur, and people with good relationships with bankers have done well to have a good banker on their side. Lawyers, yeah, there are legal things that you want to be protected from, and a lawyer is going to save you a lot of money for sure. And then the accountants. Accountants, when it comes to taxes, they can save you a lot of money. When it comes to understanding where your money's going, they can save you a lot of money. Accountants can make you money as well when you start to understand what to look for and how you can, whether you can bring your money in faster or you can just identify where your money's flowing, identify where it's coming from, and be able to bring it in more easily from those places as well. So the first thing to understand is accounting comes from this double entry method. And essentially what that means is for it's kind of like the action reaction principle. For every action, there's an equal and opposite reaction. So for every total of credits, there has to be an equal and opposite total of debits. Okay. So you have debits and credits that are going on. And in general, if you think of a bank account statement, then you're going to look at it and you're going to say debits are things that make the bank account go down. Credits are things that increase the bank account. It's not a one-for-one when you're talking about accounting. So if you're talking to your accountant, just understand that when they're talking about debits and credits. Debits in accounting, they can increase your expenses, decrease your sales, for sure, but they also increase your assets, including the cash that you have. You'll increase those accounts by debiting those accounts. Credits can decrease your assets, but they'll increase sales. They can increase your liabilities, your loans payable, but they'll also decrease expenses. So it's a little different when you're talking about debits and credits. The important thing to remember is that it kind of has to be, it has to be equal. It has to balance out. So whether you're looking at a balance sheet itself, or if you're looking at just a journal entry, it's got to be equal, your debits and credits. And what I want to do is go into some financial statements and kind of show you and explain what they are, what the concept of them is, just kind of look at as much of a high level view as possible, and then also show you how like an entry into your books can affect these cash or these financial statements, profit and loss, balance sheet, maybe even cash flow, things like that. And I'll take it just as one example. So for those of you watching on any kind of video, you should see a balance sheet up here. And the balance sheet essentially just shows where your assets are. So these are things like bank accounts, accounts receivable, things that your customers owe you. If you have any inventory, then those will go in there. If you have assets, like there's a truck here, and that's on the balance sheet itself. Okay, so that's under the asset section. And then you have liabilities. And liabilities are going to be things like accounts payable. So what bills do you have due that you haven't paid yet? There's your accounts payable, essentially. Credit cards payable, taxes that you have to pay, loans. And loans could be from people. They could be from yourself. They could be notes that you've used to finance various things, whether that's financing something like that truck that's on your asset side of things, or financing equipment or inventory or things like that in the business. And then you have your equity side, which is basically the difference. That's your difference between your assets and your liabilities. In the equity section, you're going to have things like your net income. You're going to have things like your retained earnings. There's this thing called opening balance equity. As an accountant, I don't like that. I don't want to see anything in opening balance equity. I'd rather see that in the, say, retained earnings section. However, essentially what you need to know is you've got your net income, and then everything else that's just the accumulation of what you've put into it, what you've put into the company yourself, investing into the company, that's capital that you've paid in, and what you've left in the company from the income that you've accumulated over the years. That's going to be your retained earnings. Essentially, it's going to be everything but net income. That's a very simplified way to say it. And detail-oriented accountants will get very upset with me because they'll say, oh, that's not, GAAP, or those words aren't right. But from a business owner standpoint, those are the things we need to know. And then we've got a profit and loss statement. That's going to show your income, and you may have various sources of income. And by the way, what I'm using here is just it's a sample. In fact, you could probably pull this sample up with, I believe QuickBooks you'd be able to pull up Craig's design and landscaping services. So what you need to know there is you've got at least a couple of different sources of income there. You've got design income that's bringing things in, and you've got your services income. There's a couple of other things that have a few dollars from sales of product and pest control, but landscaping services and your design income, those are going to be your big movers for this business. Then you've also got this section called cost of goods sold. What that means is if you had to purchase something in order to make the sale. So in other words, some examples, we don't have that in here right now. Okay, that's fine. So some examples would be if we had to purchase landscape fencing. Okay, that's going to be part of the cost of making that sale because of the services that you provide. Labor that goes into, I hire a contractor and have them come in and plant some trees for me in the yard. That's going to be a cost of the sale. So it's costs that are directly related to the sale goes in that cost of goods sold. And the important number that gives you is your gross profit number. And your gross profit is the amount that you have. Let me put it this way. This is the easiest way that I know to explain it. I've known people who have a negative gross profit. And what that means is before any other expenses are accounted for, any other overhead, anything like that, they've already lost money on their sales. So if they've sold a landscaping service for $1,000, but it cost them $700 in labor and $400 in materials to actually complete that sale, complete that service, then their gross profit is a loss of $100. Yes. I'm trying to make sure I thought of that right. In other words, it doesn't matter how many sales, $1,000 sales they make. If they're spending $1,100 in order to complete that sale, in order to complete the service, they're going to lose money every time. And the more they sell, the more they lose. So that's why that gross profit number is important, to know what are you making just on the front of things. That other people call it a gross margin. You may have heard that before as well. And so that's where your margins come in. And the higher your margin is, it's not a greed thing, but what that does is that sets you up to say, okay, how much money do I have for my other expenses? Other expenses can be things like fuel for your automobile. They can be advertising for, getting your name out there and actually getting the jobs coming in. Rental of equipment. It could be insurance. Insurance is a big one. There are some other costs, accounting, bookkeeping, lawyer, those sort of things. Maybe some internal cost, administration type cost, administration payroll can go on to that. Some job materials can also go into general expenses just because they're used for several things, not just for one job, not just for the cost of one sale. A lot of these things, there's some leeway to it when you're just looking at it for you as a manager and the decisions that you need to make regarding what you've got going on. So don't worry too much about all of that. Hopefully a good accountant is going to be able to adjust that at the end of the year to show exactly what it needs to show. And if there's any bank that needs something, some kind of financial statements for it, they'll be able to make it look right. If you have an audit that's happening, then they'll be able to pull the right things and put things into the right order, all in compliance, and make it look good. Right now, what I'm looking for as a business owner is, does this have the information that I need to make good quality decisions? That's where I'm coming from at this point, right? I'm counting the cost. I'm making sure that I know what's going on in my business so that I can make decisions and determine, do I need to cut back on things? Do I need to increase my advertising because the sales aren't coming in like they need to be? But this is essentially a profit and loss statement. You have a cash flow statement, and this can be difficult to understand. First of all, I want to do something though. Let me explain what happens when you make a sale, okay? And we have an entry for a sale. Everybody likes sales. I like sales, right? But let's say I have a $10,000 sale that I make. For anyone who's watching the journal entry, this is easy to see, okay? I have landscaping services and I've sold $10,000 of landscaping services. And let's say somebody pays me right off the bat, whether it's cash, check, whatever that is, they just pay me straight off the bat and it goes into my account. So I have, let's see if I have cash account here. Checking account. There we go. And I have $10,000. Great. So $10,000 goes into my account and I have sold landscaping services. And what happens when I make that entry is, let me refresh both of these balance sheet and profit and loss statements here. I have an increase of $10,000. Hopefully you can see that increase of $10,000 on my landscaping services. It went from $1,500 to $11,500 now. Okay, so that's my increase. All it was services, so there's no increase in the cost of sales. So it's just gross profit, another $10,000 in gross profit. Great. And my bank account went up. I debited the cash account, which is the bank account. If you hear an accountant say cash account, they're likely talking about your checking or savings. It's what is readily available for you to pull from, essentially, is what a cash account is, as opposed to like an investment account. So don't think of it as, actual cash as opposed to a credit card or a check, but just a cash account. And that's great and all. Okay, so 10,000 goes up on sales, 10,000 goes up on checking. But what if what if they paid half now? So we have $5,000 they paid now. And let's say they're going to pay half later. So that's going to go into the accounts receivable, another $5,000. Okay. Because now it's receivable from them. But let's say we had landscaping services was a large portion of it, but that was only $7,000. Now I've got another $3,000 that we're going to say went into design income. I have to identify where everything comes from. I can't leave this out of balance when I make the entry. I can't have a $10,000 increase over here and only $7,000 changed over here. I've got to have $10,000 total change on my debits and my credits. So I want to make sure everything balances, and this is where that double entry comes in. It's both sides need to be balanced and they need to be the same amount. If we don't know where that amount came from, then we have something we need to identify. By the way, I'm not putting in descriptions right now when I'm making these entries just for sake of time, but always put in good descriptions. If you have to do this, if you have to make these entries, put really good descriptions in because they're going to save you so much headache later. And it's the same as any kind of computing, garbage in, garbage out, right? So what you put into it is what you're going to get out of it. And if you put good effort into it on the front side, you're going to get so much better data on the back side to be able to make those important decisions with. So I'm going to save that. And I do have to choose a name. That's right, in the customer field. So we'll just use whoever they have. And let's see if we can find out what happened now on our balance sheet and our profit and loss statement. Now on the balance sheet side of things, checking went up by $5,000, as it should have. And my accounts receivable went up by $5,000. My client owes me. I'm using accounts receivable because that's going to come up in just a minute too. And then on the income side, I have design income that's gone up by $3,000, and I have landscaping that's gone up by $7,000. So I've done the work, okay? And I've received half the money, and I'm going to receive the other half of the money. Okay, excellent, very good. Let's talk about this thing called AR aging, accounts receivable aging summary. This shows you who owes you and how much they owe you, but it also shows you the aging part of it, which means how old are their accounts? How long are they taking to pay you? If you have somebody who owes you a lot and this window of 31 to 60 days, 61 to 90 days, 90 days and over, okay, that's going to be a little bit of an issue. I'm just going to throw that out there for you. That may not be something you want to have. I also want to show you this on the bookkeeping side of things. Because I made that accounts receivable entry directly into a journal entry, it's not showing up in my aging report. This is the garbage in, garbage out side of things, right? So I need to enter that the correct way, which is going to be to actually create an invoice that will show the aging on there. Now, let me see if actually that may be corrected now. I might be talking way, way old QuickBooks. Let me find out. I didn't refresh the page. Are you on there? Yes, excellent. Never mind. Scrap that. It is on there. There are other things, other issues that can come up. The best way, though, is going to be to create an invoice for that person. It'll automatically get your receivables up there. You won't have to worry about it. But let's say that this sale was made at the beginning of the year. Okay, so somebody came up to us on January 7th, and we made the sale. And now our profit and loss and balance sheet are going to show the same for the year, but now my aging shows that $5,000, they haven't paid us yet. This is one of those areas that when the rubber meets the road, especially, I don't know if it's a Christian business owner thing. I don't know if it's I know in the accounting realm, there's a lot of very, very nice accountants that don't want any conflict. And maybe that's just kind of the way it works in our world as well. But it's almost that we have this hitch of asking people for money, even if it's money that they owe us. One great thing to do is to automate this process. So if you invoice people out, it can automatically send a reminder to them. You can set it for a day later, 3 days later, a week later, a month, et cetera, and have it remind them. You can turn those old accounts that aren't being paid, you can turn them over to somebody else. But my experience has been most people want to pay you. They just forget, or something else has come up. You can work with them, and a lot of them will work with you, and they'll get you paid off. But people have a sense of obligation in that regard, and they want a clear conscience. But the important thing to know, though, on these aging reports is if you have somebody that keeps popping up over and over again as a perpetual, let's say over 90 days it takes them to actually pay you, then it's time to start thinking, do I really want to keep them as a customer? And maybe they're great to work with, but if they don't pay, that's a big question. If they do pay, but they're horrible to work with, that's another question. Maybe I don't want to work with them. But strictly from like an accounting standpoint, it's kind of like if I go and buy a miter saw, okay, and I pay for it, pay for the whole thing, and I have to have it in order to get started on this job that requires, maybe there's a detailed fence if it's this landscaping person, right? And I have to have this miter saw in order to be able to start it. And I went ahead and paid for it. And they were like, all right, we'll get it right out to you. And whether it's being assembled and delivered or whatever it is, if they take 4 months to get it to me, am I going to be a little upset about that? Yeah, I'm probably going to be a little upset about that. Am I losing revenue because I don't have that miter saw to put to work for me? Yes, I'm losing revenue. I can't even start on that job until I get it and get in there and start actually doing the work and then getting paid for it. So in that way, it's almost like the worker is worthy of his wages kind of a situation, right? Especially if I have done the work and someone owes me for that work, why would I not want to have that money? Why would I not do what I can to peaceably get that money as quickly as possible so that it can be used? It's not about the money so much. It's about being able to use it. And ultimately, for me as a believer, as a Christian business owner, understanding that God is putting me in this position to do stuff that's bigger than myself, this isn't even my money anyway. This is what he wants to use as a tool to make things happen that are going to influence the world for his glory and bring people and draw people to him. So this is a bigger purpose. If it's constantly coming down to many months that people are not paying me, people are consistently and habitually late payers, I need to rethink that situation. And I will tell you, in most circumstances that I've seen, the ones that are late payers are also the ones that I do not like to work with. They usually have the most demands. They are the most upset and least satisfied with the job that I do with them. And they don't pay for it. So they're usually the ones that I'm okay with firing as a customer anyway. But that's one major report that I would do is your aging summary. There is an AP aging. So this is accounts receivable aging. There's an accounts payable aging summary as well. And that's good to know, to help me know, am I making sure that everything's paid on time? Especially if this is, maybe I have a lot on my plate and I need to make sure all my bills are accounted for and all my vendors are being paid. Maybe I have someone that I've hired and it's just kind of a quick double check. Okay, are you handling all the payables like I hired you to pay them? And you're doing the job that needs to be done, just making sure that that's handled on time. If it's not, let me determine why. So is it because I don't have the money to pay it? It could be that, very much so. Or is it because I've just forgotten? And if I've forgotten, what do I need to adjust in my system to be able to remember and pay that on time? And there are other reports like weekly sales reports. They're great for tracking data and trends and things. And then let me actually get, let's get rid of this journal. I'm going to delete this journal entry so that we're back to what we had. And in something like QuickBooks and a lot of other accounting programs or bookkeeping type programs, you're going to have things where you have a home page, a dashboard, like the home splash page, where you can get various reports and quick look kind of reports to identify what's my income and expenses, what's my trend, okay, last month versus this month, this year, et cetera, et cetera. And there are a lot of things that you can pull. You can pull monthly profit and loss statements to see what those trends are doing. It's best to get a good accountant to identify what it is that you need. And unless you already know, that's great. If you don't, work with your accountant either way to identify what are the things, what are your goals for understanding, what are your goals for decision-making and future planning, and then identify what needs to happen because of that. And from an accounting standpoint, what kind of reports do you need to look at? Just a quick note on a cash flow statement. Cash flow statements are interesting. They're helpful for reconciling your cash balance to your net income and kind of understanding where those things go, because I can't tell you how many times that at tax time, somebody has said, how can I owe taxes? I didn't make any money. There's nothing in my bank account. And while that may be true, there's nothing in your bank account. What I'm seeing is that you did have plenty of income, like a net income was high, even if there was nothing in your bank account. Now, to see how that can happen, remember we talked about the accounts receivable, right? So if you're on that kind of an accounting system, it's called an accrual-based accounting system. And let's say I sold a $50,000 job at the end of the year, completed the work by the end of the year. But again, let's say 4 months later, it's now April, and that client, that customer has not paid me. I'm going to have $50,000 of income. And if it's a closely held business that's reported on my own personal tax return, then it flows through to me. But either way, it's income that's going to be taxed. And if I haven't gotten paid, I'm not going to have that $50,000 in the bank account to be able to pay it. Maybe I only have $2,000 in the bank account, and I don't have the money to pay the tax on $50,000 of net income. So those are the kinds of considerations that come into play, because the statement of cash flow starts with your net income, and then it takes all the activities. This is basically your balance sheet activities, and it shows how they affect from your net income to your cash at the end of the whatever period you're looking at. In this case, it's a year-to-date thing, January 1 to May 19. So what does that mean? Well, it means if your accounts receivable goes up, then you're going to make a decrease from relative to net income. So you start with net income, but you're going to decrease because your net income is showing that sale, those sales of the accounts receivable, but you haven't got the money yet. So let's decrease it because the cash isn't showing. Your inventory, the same kind of thing. So your asset side of things, if they have increased, you're going to decrease cash relative to net income. Accounts payable, that is showing as an expense over there on the profit and loss side of things. So you're going to make sure to increase cash relative to net income for increases in accounts payable, increases in credit card payable, increases in loans payable, things like that. If you have an asset like that truck that we talked about that we got for $13,495, then we bring the asset in, that increased the amount of the asset. That means it decreases cash relative to net income. Kind of makes sense if you pay for it in cash, right? But if you actually took a note out to finance it, how does that affect it? Well, the increases in your notes, notes payable, that comes in and that increases your cash relative to net income. So we've got these things that increase and decrease it, and hopefully you can see why a cash flow statement is not necessarily the same as the language a lot of people will use for their cash flow and making sure they have cash flow. The considerations that you might need to make for cash flows. By the way, a cash flow statement is good to check and make sure your cash ties out, beginning of the period, end of the period, ties out and ties back to your net income. That's a very nice thing to do, but it's not necessarily the thing you need to be able to understand what's going on with your cash. So that kind of goes over financial statements and hopefully gives you an idea of what is in there. There are many, many other things to go over. There are other expenses that come into play, like depreciation, amortization, things you don't feel necessarily in the cash aspect of it, but they're there. Interest and taxes, those things also come into play, but not on the initial side, initial net income kind of side of things. And they can come into play as far as a business valuation is concerned. So that's your earnings before interest and taxes. And then you've got other cash flow considerations to think about. How much debt do you want to take on? How much debt are you comfortable taking on? What are the interest rates that come into that debt? Do you need to have a line of credit in case you need to float some of the payroll that's going on, especially if you're in longer term construction? It can be a great thing to have a line of credit you can draw from to float the payrolls and then be able to pay that off once your payments actually come in, you actually receive the payments. However, you rarely get a better return on investment than if you've paid off all of your debt. The interest rate on debt often is so much that it's just far more worth it to pay it off than to be holding it. And especially if it's a credit card. Holding credit card balances is one of the most cash flow negative things you can do. It just sucks the money out of the company. Another cash flow negative thing is taking money out, especially if you're a closely held business. Pulling that money out of the company, it can really damage the viability of the company, damage the value of the company. There's a lot of things that can go into it. So having a clear understanding of what money is in there, having a clear separation between this is my business and this is me personally. Those two accounts don't really mix and shouldn't mix is very important. Understanding the Proverbs about preparing your field. Do your work outside, prepare your field, and then go and build your house. Make sure that business is prepared and it's done well. Business is taken care of, and now let me go and take what's coming in from that business, and I can prepare my house. I can build my house out of that. Extremely important principle as well. And then also understand debt is not evil. Money is not evil. Debt is not good. Money is not good. Those things are tools. If it becomes an idol, then it becomes evil. It becomes a sin. It becomes what it shouldn't be. But if it's seen as a tool, not just a tool, but a tool that is free and available for me to use, but not mine so much. Like I am a steward of it, and I am to be a good steward of it. If I can look at it that way, I can change the way that I approach the whole thing. I can approach it from a much more sustainable focus. Again, I've said it before, but so often I am so short-sighted that I only focus on the future when I should be focused on eternity. And that's my purpose. That's my vision with any company that I've worked for, anything that I've done in my life, and this company that I have even now, whether it's Greenhouse Services, whether it's this Brilliant Fools podcast, brilliantfools.com, coming soon. I promise it is. And so hopefully this has been a good, let's say, a broad overview of a detailed subject. So a 30,000 foot view of the bark on the trees of the forest, right? Hopefully this has been good for you. And if you have other questions, please let me know. You can also reach out to info@greenhouseservices.com. So that's greenhouse, Greene, Greenhouse Services, or no, this is info. Let me back up. The actual email address is info@greenhouseghs.com. Greenhouse Services was taken. Yes. So info@greenhouseghs.com. I'm hoping to get all those things sorted out soon too. I say I'm hoping. That means I'm confidently expecting to get those things sorted out very soon. God willing, and as he leads this, I'm excited. I'm looking forward to what it is he does with it and what we might be able to do together. Thanks for joining me. We'll see you next time.